Hi, everyone. Colin Plume, CEO, Noble Gold Investments, My Digital Money, and a few other things. I got Micah Haynes with me today, and it's exciting. We got gold breaking through 3,500. Silver broke through 40, so we got a lot to talk about. And I was talking to a friend of mine over the weekend that read my book, Silver's the New Oil, and I was saying that when the book came out in December of last year, I felt pretty good about silver breaking 40 an ounce, and he thought it was a little aggressive. And he came and gave me a big hug because he took my recommendation, bought a lot of silver, and so he's pretty happy with how silver is done. But let's dive in. Hey, Micah, let's get you on the screen. How you doing?
Hey, really well. How about you? End of summer here, start of school, big breakouts in the metal. So a lot going on, Colin.
Lot going on. Yeah, welcome back from your vacation. Good to have you
Thanks.
back.
Yeah, feeling great. Should be a busy fall for us. So much to cover, so much going on. And just to go to your friend, I think he's going to owe you another hug here in a couple months.
I know. No,
Big
he
one.
was so happy. And I think he has been looking at silver for a long time. And so it was a nice kind of entree to get him excited about it. And yeah, we just kept it simple. We did 100-ounce silver bars, and
Perfect.
he's blown away by the profit that he, because you're talking about silver was like, I want to say like 27, 28 around when he bought.
Yep.
So now we're above 40. So
It's funny. It's on vacation. My uncle, who holds quite a bit of gold, maybe like, let's say $500,000 or so in gold, but has like no exposure to silver, basically told me,
he's ready.
why didn't I buy this stuff when you were telling me to? And I said, it's not too late. You got a long way to go.
Yeah.
So we'll jump in on that note if you're okay with it.
Let's do it. Let's go. I'm excited. Yeah, let's get you on. Let's do some charts and graphs.
Pull up the gold chart first. So we'll zoom in big here. What we're looking at is really the move that we had since the spring. It's been a very slow and congestive summer. We haven't actually been able to break out until just, end of last week to new all-time highs in gold. So above 3,500, like you said. But if you look at this box that I've created, it's essentially a 5-month, 4.5 month period where the price of gold just went, up, down, and kind of remained within the confines of this box. So from Christmas to April, we went from 2,500 to like 34. Huge run. Okay. Massive run, which kind of coincided with the dollar, rolling over from the post-Trump spike. The dollar dropped about 12% from January to now, but we had a very precipitous drop in the first, quarter and a bit. But basically we had a massive run from Christmas to early April. And then a lot of people were expecting it to pull back, right? 2 steps forward, 1 step back is kind of the mantra for, any sustainable bull market, right? You want it to rise and then fall and then rise and fall and kind of go up in that kind of fashion. But we never really got a pullback. But what you can see here is instead of the price dropping and getting that, 2 steps forward, 1 step back, where it does drop and give us a reset, when it goes sideways for many, many months, you actually get the same effect as a reset because you allow I won't get too technical here, but the daily moving averages to catch up. So it allows essentially the price and the sentiment and all those things to reset the same way as if you had a crash, but it just takes longer. It's more frustrating. But now on the heels of all the Fed, stuff from Jackson Hole, a week and a half ago now, it's just ready to roar.
Can you explain that a little bit more in detail? Because I think from a layman's point of view, you're sort of saying like you need a little bit of a correction, but now you're saying if it stays in a range, that the daily moving average moves up. And I think you should explain that a little bit.
So if JR can blow it up and maybe even zoom in and go to the far left side of the box, what you've got is that little blue line under the actual price action. And that's a daily moving average. Okay. So that basically shows you
I see.
It shows you like the volume of buying or sorry, it's that's RSI. The daily moving average is essentially like the average price over the last, let's say, 50 days. So the
Mhm.
50-day moving average is kind of like a trailing price indicator.
Right.
And you can see that the blue line below, let's say at the end of March, early April, mid-April, there's a pretty big gap between the blue line below. Go to the left side of that box here. So that blue line below and where the actual price is very stretched. Okay, so you can get these stretches where price moves way above the actual daily moving average. But what you want, and this is fine in an advancing phase, especially at the end of an advancing phase, what you want then is to have a price reset where it comes back to test the daily moving average. So,
I see. So just to kind of break down this chart so people understand, when
yeah.
you're at, to go a little bit to the left, JR, when you start at, like, they're buying right there, and if you see the arrow,
Yeah.
people are buying gold at like 3,000 in April, and then you see that blue line moving up,
Hmm.
and it starts to move up there, and now they're buying it a little bit higher, and they're buying it a little bit higher. So now they're buying gold closer to the actual price. Is that what you're saying?
Pretty much. I'll put it this way. The moving average is essentially the average price of the last, let's say, 50 days.
Mhm.
And the daily price can be, higher or lower than the
Mhm.
average depending on any given day. But when you have a really fast move upward in the price, the daily price, which means, the price is shooting up, the last 50 days, the average of those doesn't necessarily catch up. So it leaves it
Got it.
behind.
Okay.
So the daily price is moving a lot faster to the upside than the moving average or the last average of the last 50 days. So why this is important technically is you do end up with these like stretches or kind of imbalances where the price is much higher than the moving average below. And again, like in an advancing phase, that's expected. But then you can see here through the length of this box, you then have the daily price come back to touch the blue line, and then it pops up.
Mhm.
And then it comes back to go below the blue line, and then it goes way back above. And then it comes back below the blue line. And so you want to see the the moving average catch up to the price
Got it.
or the price drop down to the moving average.
Yeah,
And
and this also gives traders confidence too, right, Micah?
exactly. So if you've got, the moving average here and the price here, one of them has to come to meet the other.
Got it.
But if you're just going sideways for a long enough period of time, they kind of meet again because again now the 50-day moving average, for example, is pretty much where price is at,
Cool.
which means they're not stretched, which means now from a technical trading perspective, the actual price has a long way to go. And
You
the
created
fundamentals are there as well, but just from a technical side, now you've got people going, "Okay, we have a lot of room to run now. Let's see it."
Yeah, and so you created a new floor price in
Yeah.
theory. I mean,
Yeah.
obviously anything can happen, but it seems like we've tested a range in the 32 to 3,400 range where it stayed for a while, and that's why you're saying it sort of acted like a correction.
Exactly. That's like the Cole's notes is instead of getting a correction, we just went for a sideways churn. The
Okay.
effect is the same. We've reset price, we've reset momentum. We now have a ton of juice technically to run hard through the fall. And that's what I think will happen. But the arrow I've drawn on top of the box suggests that we'll probably break out of this box, maybe go to 3,600 and then maybe come back to retest the breakout level at 3,450. But then we're off to the races, and I could see us closing the year closer to 4,000. But we'll take it one step at a time. But
Right.
this is big, right? So big breakout after a very long consolidation, and we are very excited. Now we'll get into some of the fundamentals, or like let's say the big macro kind of economic themes as to why they broke out at Jackson Hole. Now let's zoom out of this. Oh, take a step back, and we can get our handsome faces back on here too if you want. So we'll have a conversation about this. Colin, is
Yeah.
what's fueling it, right? So August 22nd, 2 Fridays ago, the Fed had their big annual thing at Jackson Hole. And they pretty much said, we think the economy is slowing down. We see kind of signs of recession. But at the same time, inflation data also came in higher than expected. We still have 3% inflation when they wanted at 2, right? So it's still actually inching up and nowhere close to their actual target. And so they've suggested that they're going to have to shift interest rate policy to accommodate slowing growth, and basically they're going to cut interest rates at the next meeting, which is September 16, 17. And so the markets are pricing that in now. It's going to be a quarter point or 25 basis points, so 1/4%. And there's like a 90% certainty of that the market expects that. So why is that good for gold? Well, cutting rates, again, is kind of an admission that the economy is slowing down. Gold is a safe haven, of course, which means if the economy is slowing down, we're seeing signs of recession, you could see a stock market crash that follows, and smart money is rotating into gold before anybody else. Unfortunately, that's how it works. But the other big thing is the dollar will weaken if we lower interest rates, right? There's less demand for the dollar, the lower rates go, and essentially the gold price is just reflecting that weakness in the dollar as well, right? So the big reasons why it's breaking out is because the Fed's policy stance is very dovish now, which means they're actually getting kind of scared about economic conditions again, and they're wanting to accommodate it. But all that stuff that they'll do to try to save us from a recession is like the most bullish thing you could expect for gold, right? Cutting rates and maybe printing money, a return of QE, that stuff will send gold and silver to the moon. But, again, this is early days. Just the announcement of their stance at Jackson Hole is what's really giving gold and silver this boost to run higher now.
Absolutely. Yeah, no. And I think, when you look at gold price, I also like, I like round numbers, and gold is 100 times up from where it was in 1971, 1972. It was at 35 ounce ounce, and now we're at 3,500. So it's gone up 100 times.
Which means purchasing power of the dollar is down like 99.9.
Exactly. Yeah. And also, if you look at the percentage return on gold, because, you see all these guys saying it's not a good return, but actually since 1971, the average return for gold is 8.9%. The S&P 500 is 8.1%.
Wow.
So actually gold has actually outpaced the S&P, which I think is pretty, because people, it's not performing or it's not doing this, but actually it has performed well.
Yeah. And I think a lot of those comparisons from 2020, gold's done a lot better. And even since, I think, 2008, even the bottom of 2008, and
Sure.
then just this year alone, right? Like gold's up 30% or so.
Absolutely.
So I think that's important. I do want to talk a little bit about the big picture macro stuff, just a little bit more. I brought up some other points that I think are worth talking about. So this next slide. So with inflation, I mentioned that it's at 3% or 3.1% is core inflation right now. They've been saying they want it at 2. They'll never get it back there. So what they're eventually going to do is just allow it to kind of go wherever it wants. But Colin, I've been saying this to clients for years, in fact, is that you can try to prevent a recession by keeping rates low, but then inflation runs higher. Or you can raise rates to try to bring inflation down, and then you crush the economy and cause a recession.
Right.
There's literally this kind of like stick handling that the Fed's been doing for many years to try to prevent both at the same time. But it's really going to end up with stagflation, which is you end up with the worst of both worlds. You end up in a recession and with the price of everything running away. And that's something we haven't really seen since like the 1970s, which of course was like the biggest precious metals bull market of all time.
Right.
Where
and stagflation is low growth, high inflation.
exactly shrinking economy, but the price of everyday necessities just they continue to, so the price of gas, price of food, price of house,
It's
everything's
a
just going.
nightmare scenario.
It's the worst case because everyone's like either not getting raises or losing their jobs and also having to pay more out of their pocket to put food on the table.
Correct.
And so the last time we had that was the 70s after we depegged from the gold or the dollar from gold, and gold 25 times in 6 years and silver 37 times in 6 years. So I think we'll see something similar, but unfortunately what's happened is this back and forth of raising rates and lowering them is just painted themselves into a corner. So we're cutting rates now with the stock market at all-time highs and inflation still hot. What's going to happen, right? Like asset prices are going to continue to go higher. The dollar is going to continue to weaken and the price of everything is going to continue to go up. And I still don't think they can really do much about a economic recession. I think it's on the way either way. So very tricky spot to be in. If you try to straddle the fence and avoid both sides, eventually I think it kind of falls down and you end up with both things you tried to avoid. So
yeah, Bank of America came out and said they upped their gold prediction to 4,000 an ounce by Q1 of 2026.
wow.
So that's pretty interesting.
That's in line with my call. That's bullish for a bank, right? Banks don't normally put prices like that on gold.
Yeah.
Wow.
And then I think the big stat that is now central banks are holding more gold than US dollars. And that's the first time that's ever happened in, probably since the Bretton Woods exchange, right? I mean, it's probably been a long time. So that, central banks have been selling their treasuries, buying gold, right? And so this is the first time they have more gold than US treasuries.
And that's amazing. That trend really started in 2022 when Russia invaded Ukraine. And then the US froze like 300 billion worth of treasuries that Russia held. And not to get political, but they basically froze US dollar assets held by another country that they didn't agree on something that they were doing. The reason everyone else is de-dollarizing is because of that. They don't want to do anything untoward necessarily right now, but they want to reduce the liability that they have of having the US potentially freeze and steal their dollars. So they see holding too many dollars as a big risk. And so China's selling treasuries to buy gold. Russia's been doing that for years. Japan's doing the same. The East at large essentially is, like you say, dropping the dollar to own gold. And we finally hit that point where they own more gold than dollars, which is pretty wild.
Yeah, absolutely.
So we can move on from that. I want to talk about yields because if you remember, Colin, this time last year we cut rates for the first time since we started raising them. Right. So since COVID, after COVID, we only raised them, and last year we cut the interest rate by 50 basis points in September. And what happened? Yields on long-term bonds shot a lot higher. And actually, if you look at this trend, they've been moving higher for years because I do think that the secular, kind of theme of lower rates over time, it changed a couple of years ago, right around COVID. But the reason this is significant is even today, like we're seeing the 30-year treasury yield go to about 5%. Okay. It hasn't been this high since 2008, right before the global financial crisis. So the reason that this is important is that higher rates on long-term bonds, so the 10-year, the 30-year, it implies two big things: higher consumer interest rates on all debt, car loans, mortgages, credit cards. And it also means that the government is going to be paying so much more for their debt, the national debt, right? So they've got no relief on debt for the government, which means higher borrowing costs. It means more deficit spending. So it's bad for both the government and the national debt and the consumer. So The reason this is happening is because no one really wants to own long-term government bonds anymore. So if
Right.
they're selling their bonds, that moves the interest rate higher. Now, those that are still holding, the bag, so to speak, with respect to government debt, they're getting paid a little bit more. The yield is going up, but they're dropping. And this is to the point you just made. They're selling bonds to buy gold.
Mhm.
And this is happening again, almost the same as last year. We're 2 weeks away from another rate cut. Maybe it's not as big. Last year was 50, but now we're expecting 25 basis points. But they're going to cut rates when long-term yields are moving higher into that, and the reaction will very likely be that long-term rates will continue to move higher even after the cut.
Well, and also the buyers are different now, right? It used to be central banks that were buying, and now it's retail buyers. And so retail buyers are more finicky. And so
Yeah.
you have to appeal to a retail buyer to buy this long-term debt when we're out of control with spending. So you're like, buy our debt, even though we're $37 trillion in debt. So there's not going to be that frothy demand for that long-term 30-year debt when
Yeah.
there's so many other options out there. Gold, silver doing much better,
Absolutely.
and seemingly to be safe options. So why would you buy another safe option and make 5% when you can make 30+% in gold, 40+% in silver? It just doesn't. It's not an appealing option right now in this economy.
Exactly. So I think you're right. It's a lot of the smart money has already left government bonds. They're into gold, they're into silver. That's what moves the price so much to this point. But retail is still kind of in this stuff, right? So
Yeah.
there will be a big kind of general public rotation of capital out of bonds and into the metals. But I don't think we've seen that yet. I think that's actually the thing that we should expect to see over the next, weeks and months is rotation of capital from the general public. Wall Street and the smart money always moves first, but we'll see that next. So I just think it's important to know that we're kind of doing the same thing as last year. We're cutting rates as yields move higher. Higher yields makes it more expensive for the government to have all this debt and for the consumer to spend. So that's just going to compound all these recessionary effects, right? You're not going to have people out there buying and stimulating the economy if everything costs that much more. So it's a double whammy. Again, it's more kind of like to the stagflationary point. It's
Yeah,
not
and
going.
you're talking about institutional big money moves. Harvard Endowment just bought a huge stake in Spider Gold, which is basically gold
Yeah.
ETF.
Yeah.
Saudi Central Bank just bought 30 million in silver iShares. They also bought silver miners. So you have this institutional, these endowments, this big money, moving into these gold and silver, basically in essence.
And the last 2 points you made about the Saudi investment in silver specifically is huge. Like normally you don't see countries touch silver. It's
Yeah.
now listed as a strategic commodity in the US. Russia is actually listed as a strategic commodity a couple of years ago. But now you've got this like big high net worth, either individuals or countries themselves stockpiling this stuff. And there's really not that much to go around. And I'll get to this at the end where I talk about silver becoming unobtainium. But let's actually look at what silver's been doing.
We're done. Okay, silver. Here we go.
Hold on, JR. I want to just go back. So I got excited about silver, but this is just really quick here.
You jumped the gun here. Yeah.
Jumped the gun a little, but going into a Fed rate cut in a couple weeks, this week's super important. It'll very likely determine if it's a 25. There's a small chance it would be a big cut, like a 50, but there's a couple things happening this week. So Friday's the big one, but between today and Thursday, they're doing JOLTS, so job openings and labor turnover. So essentially, they're just going to see whether or not there are more or less jobs being produced than what they expect. If we've got more jobs, maybe it's only a 25 basis point cut. If there's a lot less jobs, maybe it's a 50. So I don't think it'll change much, but I do see the data releases being very important. And then non-farm payroll, so essentially all jobs that are not seasonally related to any kind of farming. That's a really big one. So we'll just have to see what comes out if we're shooting high or shooting low on expectations, and that'll again will just feed into the rate cut that's already going to happen. It's just what size and what kind of tone are they going to take.
Silver,
Okay.
ready for silver? I'm ready.
I am
for
now.
silver.
I am. Let's go. So this chart,
Silver over 40. Boom.
boom, highest close in 14 years.
Wow.
So 40, like you said, big round number, psychologically very important for folks. We are above that now, 2 trading days in a row. Not to say we couldn't maybe retest the, kind of high 30s, 38s, 37, something like that. But my view is 40 was really the last barrier to 50, which nominally is the all-time high. And I say nominally because, we've been there, 2011 and in 1980, pardon me. But we've talked, Colin, a couple times about how the 1980 $50 silver today is like over $200
$200.
when
Yeah.
you index that to inflation. So to me, getting to 50 is going to be actually pretty easy from here.
I agree.
But
I
I'm
think
waiting.
it's going there this year.
Oh, I think it's
I think it
higher.
breaks its all-time high this year. I think in December,
Yeah.
you and I will be talking about this, and it will have broken its all-time high.
Yeah, your buddy who bought your book and bought that silver will probably have hugged you two more times between
Yeah.
now.
Well, he said he's going to come back in with another buy, which I thought was
Good.
good.
Yeah.
And I think it's still the opportunity. Like, I think it's funny because people love gold with us, but I really do think this silver opportunity is unbelievable.
It's
And
bigger.
they can't miss. Like, I know it's not as shiny and the allure of gold is there but you see the Saudis buying silver, you just see all these big money people buying into silver now. I think they've all realized that it's been overlooked.
Oh, I still maintain it's likely the cheapest asset on the planet, considering how important it is,
Yeah.
the value that it provides, and really how much there is to go around on a supply and demand basis.
Yeah.
So 40, we just crossed it. Big round number, psychologically very important. But this is a 50-year chart of the price of silver. And to get technical again, what this does is it shows us a cup and handle formation. Now, if you look at the big kind of dome, that is what's referred to as the cup. And the smaller little half circle on the right side, that's what is referred to as the handle. And then you've got the line across, so the rim of the cup and the rim of the handle. That's really the all-time high at around 50. Let's just call it $50. So when we break above that nominal all-time high, it gives us room to hit. This arrow shows you something in the 300s. I have no doubt that a triple-digit figure is where we're going. But there's a couple things to highlight with respect to cup and handle charts. Like, doesn't matter what it is. It could be some stock or some company, but it's one of the most bullish setups that you can expect. So when you see this pattern, what you expect once it breaks out of the top of that rim is big move to the upside. But there's a saying called the longer in place, the higher in space, meaning the longer it goes sideways and the longer the formation of the chart can really be drawn across, like the time frame, the bigger the move you'll get once it finally breaks out. And there's no other asset on the planet that has a 50-year cup and handle that's this clean and this beautiful.
So you're saying if the small handle
Yep, the
became
right side over there.
became a big handle, became a big over, like, so let's just say it chilled in the 40, 45 range for a while.
Yeah.
Then once it broke out, then it would move faster, much higher, because then it's sort of similar to what gold did, is that you have the daily average and the buyers sort of get comfortable in that 40, 42, 45 range.
Yeah.
And then once it spikes, because I mean, with the Fed talking about, I mean, I've heard rumors of like 4 rate cuts over the 12 months, like from September to September.
Right.
And that would be similar to what happened in 2008 and 2009, right? I mean, that's what happened. They raised rates quickly because we had the financial collapse. And then they realized like, holy cow, like we're in trouble. So they started to cut rates, and then they did quantitative easing.
Yeah.
And so you had that perfect storm, and silver went up to 50, but it was never this close to 50 before. It was way, way below. I mean,
Yeah.
it was like silver was in the
It was like $6-7 at the bottom of 08.
Yeah.
After
Was it
3
that
years.
low? $6-7?
$6-7 in 08, 09, and then it went to
Straight up
50.
50.
Yeah, it went to 50 after that. And so when we talk about a measured move, if you look at that arrow that's kind of drawn in the middle of the bigger bowl, the actual cup itself,
Yeah.
you kind of take a peak to trough measurement, and then you add that to where you could go if you break out of the rim and you break out of this resistance on the, which if you look on the far right side of the handle, we're right there, right? Like and that's what I'm saying. $40 to $42 is super key. Over 42 and we'll bust through 50, no problem. But once you put in a new all-time high, like we did with gold, last year, you're in blue sky territory. There is no natural ceiling on the price, and that's where you can get what's referred to as like price discovery. The actual price of an ounce of silver could be $500. It could be $1,000. I don't think it's going there necessarily, but it's just like, well, if there's none of it around, because every country's gobbling it up and storing it strategically because they need it for missiles and batteries and whatever the case may be. It could be something that big, but just that measured move from peak to trough shows us that we could see something like $200 to $300 silver, and again, could be much higher, but we'll just wait and see. But so the purpose,
it'll get to 500. I mean, it's not going to get it. I just think we got to get through 50. We got to get to 100. Once we get to 100, then I think you'll see really people will start to really talk about it. Similar to how they talk about gold, similar to how they talk about other assets. I still think it's not in the zeitgeist yet.
Exactly.
And by the way, I want to tell you, I love your peak to trough saying. I feel like I want to get a hat that says that. That's a hilarious. I know that's
peak
such a
trader.
You always surprise me with something.
Good. Oh, I like it. Well, I've got my Noble Gold hat on, but I'll maybe make you a hat and send it
I love it. That's great. Oh man,
well, that's why people have been calling me crazy, because when I'm buying silver at 11 and $12, 7, 8, 9 years ago, they're like, where's that going? Why are you buying that? And now it's $40. It's going to 50 this year. I think we'll end the year maybe towards 60, but at triple digit numbers where I expect it goes. That'll be like a 10x on my original ounces, but I actually think it's going to go much higher into that, let's say 2, 3, maybe higher, but we just have to see. But the biggest thing, just going to that last slide that we had up, is I actually think it could be near impossible to get this stuff. So I joke with clients saying, you do want to buy it because obviously price hasn't really gone anywhere near where I think it's going to, but you want to buy it because we still have it. The tricky thing is that if you call me once it's popular, it might be 50, it might be $100, but it actually might not be in stock. Now, Colin, we've never run out of silver, just generally speaking, but we have run out of some of the more, let's say, cost-effective formats that you want to own it in. And that could be, silver rounds, for example. Usually those are the first to go.
Yeah.
We've seen a couple instances where we've been out of coins and rounds and things like that.
Absolutely.
Like March of 2020, January 2021, March of 2023. Like I've been through many of these where you call me up and say, "Hey, I want Eagles," and I say, "Well, I don't have Eagles, but I do have St. Lucia Flamingo 1 ounce silver coins, and they're still fine. They're still pure silver, but you do not want to be calling me and just accepting what I have. You want to be able to actually get what you want nice and early."
Yeah.
So
let's lay this out. I mean, you got silver constrained supply.
Yeah.
Let's lay this out.
I will. So constrained supply, silver, 70% of all the silver that's mined is actually essentially a byproduct from base metal mining, meaning like the big copper, nickel, and aluminum miners, they find silver along the way. So 70% of all the silver that's ever mined is actually found this way. There's
Right.
not a really solid way of just flicking on a switch and delivering a bunch more silver, because these guys aren't flicking on a switch to increase production necessarily just because they're finding silver as a byproduct.
Yeah.
There are very, very few pure silver plays, meaning a mining company that just does silver, that has a massive silver deposit. There are
Correct.
fewer now than ever before. And that just means you can never really add a ton of silver to the supply
Supply.
chain.
Yeah.
You can't.
Yeah.
Now,
Industrial priority. Let's get into that. What's that mean?
yeah, so basically right now you've got again not strategic stockpiling, but you've got all these government programs for solar. China's got
Yeah.
them, California, we see it's big, but most of the demand, the highest increase in terms of the industrial demand components are coming from solar, new solid state
Right.
batteries.
That
So
pulls it out of inventory. So then there's less for
exactly,
investors, right? Less
exactly,
availability, less opportunity, less, which is what you alluded to earlier. Is there's opportunity right now because it's available, but if there's none for investors, if it's all industrial, then you missed out.
exactly,
You missed
and
the window.
that's exactly it. So 60% of all the silver that's mined goes to industrial.
Yep.
And that's expected to grow by about 80% in the next 5 to 10 years because of EVs and solar and whatever else. It
Right.
has tons of applications. Like even Lululemon uses silver in their clothing
Mhm.
because it's antibacterial and there's no stink and there's no whatever. So it's got silver lining in clothing. And the point
Absolutely.
is, if 60% of all the silver that's mined is going to industrial, and industrial consumption of the strategic metal is going to go up by 80%, well, that basically means that like 90% of all the silver that's mined is going to go to industrial. It's not even going to come onto the market for
Yeah.
investors in the form of bullion.
Right.
So,
And
it's crazy.
And so you got falling inventories, right? You got, not as much inventory there. And now we're talking about strategic stockpiling.
Yeah, and falling inventory, to touch on that, what that means is like big shareholders in like PSLV or SLV, like these ETFs that supposedly have a bunch of metal underlying your actual shares. Well, only when you're a high enough net worth investor with a big enough position, you can actually withdraw and,
Right.
and take those metals out, which is what's happening, right? Because again, the smart money is going kind of the path of least resistance for getting your hands on the actual physical metal itself.
Yep.
And then talked about this earlier, but strategically stockpiling it, right? Like we used to do that in up until about the 70s because we needed it for film and radar, technology and all this other stuff. Now we need it for missiles and everything else. It's the best conductor. So it's really like, again, silver is a monetary metal. It's been connected to the currency, but it's also a super strategic commodity. And as far as electrification and all this other stuff goes. And then we already talked about the historical precedent, Colin. You and I have been through these phases where once the public decides it wants silver, whatever the crisis behind the drive for metals is, may be, it doesn't take a lot for us to actually run out of all the stuff that you probably do want. It's not to say that we won't have silver, but I urge people to say, not only is the price still very attractive, but the fact that you can get some physical now is probably the most important thing.
Yep.
Don't wait for it to become, as I jokingly call, unobtainium.
Yeah. And to wrap up, Micah, because we're coming up right at the time here, what's anything you want to wrap up with? I know we went over a ton today. So
Yeah, I would just say the next 2 weeks are crucial for people to kind of get their not act together, but I know people turned off from their portfolios in the summer. That's normal. I do too. Like no one's monitoring their portfolio and stuff. They want to just have family time and enjoy their vacations. It's a really good time to kind of look at your statement from last quarter, Q2, figure out what's going on, what's working, what's not. And I do suspect we'll have a very strong fall for the metals. We always do. Fall and spring are huge, while summer and winter can be these kind of sideways turns like we just saw in gold. So now everything seems to be reset. We're getting the conditions that we need from the Fed. The global kind of geopolitical scene is still very bullish for the metals too. So just I know everyone's getting back from vacation, shaking off the dust and stuff, getting back to work and back to school. You and I are both doing that right now.
Oh, yeah.
Once people are ready to go, give us a call. You don't have a ton of time before I think we start the next rally and start seeing new all-time highs in both metals. So Thanks, Colin.
Absolutely. Yeah, Micah, the best in the business. So many good charts. People always asking about Micah. Thank you for breaking it down in a way that everybody can understand. And if you just want to talk about owning silver, gold, platinum, palladium, give Micah a call. He can break it down in a very simple way. We do have some good promotions going on with Noble Gold Investments. And also check out the book, Silver's a New Oil, on Amazon. Actually, if you call Ask Micah, we can get you a code, get the book for free. But thank you to everybody that jumped on. Hopefully it was informative.